You're about to join Niels Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Cem Karsan and I, Niels Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Cem, it is wonderful to be back with you this week. It feels like it's been quite a while since we last spoke. How are you doing?
Doing well. It's been a busy summer and into fall for me. So have, in particular the last month, been kind of all over the world, meeting clients and potential clients and speaking at conferences. So it's been fun, but I'm excited to be back in Chicago and settling down, spending time with family and with work, getting into more of a routine.
I know exactly how that feels. Been on the road myself, and it's actually really nice to be back home. Anyways, we've got a pretty good lineup of topics, thanks to you. And before we tackle those, we also have a couple of questions. But before we even get to that, one of my favorite questions, as always, to pick your brain about just couple of minutes, big picture. That's sort of what's been on your radar. Nothing linked to necessarily the topics we're going to talk about. Just something that you picked up on your travels, maybe that you find interesting.
Oh, from the travels, I think there's a lot of similar hand-wringing globally about kind of a realization that we might be in a new regime. I think that was not the case 6 months, a year ago. People were still holding on to this hope that this was all transitory and things would change. So I think there is a broad acceptance that we're in a global time of strife, geopolitically, economically, and I think from a financial market side, people are really trying to pivot and adjust. And these things don't move fast, right? These are, trillions of dollars of capital trying to reassess. And so that's been really interesting for me. A lot of those conversations, things that we've been talking about here for maybe 3 years, or 2.5 years, are really now kind of becoming more central to the narrative. A lot of talk about inflation, and what that means and whatnot as well. So I think that was kind of the overwhelming takeaway. Vol people are confused by vol more than ever, which I think is a great opportunity. And I think, vol, as you and I were talking about, has done really some unique things relative to history. And everybody's waiting for it to mean revert to where it was. And I think it's not going to be that easy. We'll leave it there.
We'll leave it there. No, that's absolutely true. And I agree with you with some of the topics you just talked about on my travel. That's certainly also what I come across. And also I think people are just confused about the whole fixed income space and bonds. And I know we're going to dive into that as well. Before we do, as usual, let me just quickly mention a couple of things about trend following. Partly because we're just recording in the first couple of days of November. Can't believe it's already November. And so October just finished. And, of course, the outbreak of another war in the Middle East, tragic, was really something that, had an impact, I think, on trend following performance. I would say it's kind of flat to down for the month of October. Main correction in performance coming from energy prices that took a dive and global equities that continues to slowly correct, even though the last couple of days have been a bit better. Many sectors were pretty uninspiring, frankly, and only small gains or losses. And as I said, the industry looks like it's overall pretty flattish, actually, heading into the last final stretch of the year. So we'll see how it all ends up. My own trend barometer finished the month, and actually also, I think, yesterday at 41. That suggests a neutral to weak reading. So that, I think, is in line with the numbers I'm going to quote now, because the BTOP 50 index was down 0.71 for the month of October, up still 1.78 for the year. SocGen CTA index down 1.2%, but up 0.57 for the year. SocGen trend down 9 basis points. Looks a bit low. Anyways, probably right. And up 86 basis points for the year. And the SocGen short-term traders index down 47 basis points, up 1.35. Although when I look at these numbers, I'm not entirely sure if I typed something, mistyped them. Anyways, what I didn't mistype was that the MSCI World was down almost 3% for the month, up 6.38% for the year, and the World Government Bond Index down another 71 basis points, not having a great year either this year. And the S&P 500 down 2.1% and still up 10.69% for the year. All right, with that out of the way, let's move on to the questions. First question comes from Tim. Tim writes, welcome back from your well-deserved holiday. For your conversation with Cem, I would be interested in getting his insights on the following. The firm I work for runs a systematic risk premia strategy with a trend-following bias. Hence, equity market corrections and risk-off periods in general can be profitable for the strategy depending on how these turn out in terms of speed and length. Since we are medium-term in frequency, like most CTAs, a significant tail risk for us is that fast short-term movement, against the underlying trend. The question then is, what systematic strategies would Cem consider suitable for hedging this type of risk, and at what cost? I'm asking this question in light of the developments that took place post-COVID, when many investment banks offered newly tailored defensive/tail hedge strategies that were supposed to protect against major equity drawdowns while not being as expensive as purchasing put options. The range of products was wide, with strategies based on correction, variance, dispersion, etc. Unfortunately, many of these products were over-optimized to show good hypothetical performance during COVID, but most of them failed to protect subsequently in 2022. Many thanks in regards, Tim. Okay, well, I know nothing about these products. Hopefully you know a little bit, Cem, what Tim is referring to, and maybe you have a few comments on that.
So I think the idea here is that you can digest premium, right? Hedge it with other forms, right? This is essentially warehousing risk that happens all the time. There's edge and ways to do this. They can be profitable strategies, and they can even perform quite well, as they did last year, right, into a decline. If vol doesn't, perform particularly well on a fixed strike basis, and so this is the general basis of these premia systematic risk premia strategies. The problem is they have a tail. This is selling vol at the end of the day, and the question is, how do we hedge this tail without paying a lot of money? At the end of the day, the answer is, I think I can attribute this to Chris Cole or Corey Hofstein. They both said the same thing. Risk cannot be, you can't destroy risk. You can only, change its shape, change where it is, right? It can only be transformed, I believe. And so I think that's true, right? There is different parts of the distribution that you are subjecting yourself to in time and space whenever you harvest risk premia. And if you're trying to get a tail, not all tails are the same. Everybody wants to think in two dimensions, up and down. What will hedge my tail? Well, there's not one tail. There's different parts of the tail, and what you want and what you're willing to pay is a function of that. Now, some parts of the tail are more expensive relative to their output in those scenarios. There's also you have to think about probability. When I say expensive is two parts. One, it's relative to other things. Statically, is it more expensive? And the other part is relative to its actual predicted probabilities, right? And the reality is both of those things can be edges. If you can really look in relative value space and say, this is cheaper, or this is more expensive, you have an edge. And if you can also say, hey, the probabilities of this are less likely than people expect, or more likely than people expect, then you can also have an edge. And I think the key is to find ways to take advantage of those two things. There are generally not systematic ways to just do that. You need systems and you need expertise. And so I can't sit here and just say, hey, if you just go buy X puts, now there are trends to this. I could give you general tendencies, but those things change over time. And the reality is that, up until more recently, gamma is a more, there's a reason theoretically that long-term capital management was created. Long-term capital management was created because theoretically long-term skew in vol is overvalued relative to short-term. And gamma pays more than Vega over the long run, and is more consistent. And so that's generally been a structural way to do this. Is some people sell calendars and buy extra units and premium neutral and do things like this to cover their tail. The problem with that is exactly what happened to long-term capital management. Is there's a liquidity premium, and that liquidity premium works and works and works, and then at some point has the potential to, long-dated things can go anywhere. And there's some risk to that in the interim. And you have to kind of be able to size appropriately and manage position. So I know that was a lot of hedging, if you will, to the answer, but I think the point is it's complicated.
It's complicated. And, just sitting listening to you, and this might come out as a super naive question, actually. Anyways, I come from a world where it's very science-driven, right? The trend-following world is very science-driven. But I wonder, could you say that actually when we talk about tail hedging and all of that stuff, those type of strategies, it really is more of an art than it is a science, and it is very hard to come out with these purely systematic approaches to tail hedging?
I would qualify as it is a science, but it is a more complex science. And then when you have something that is incredibly complex, it is hard to model all of the factors, or at least explain them in two dimensions, right? We're talking about a very multidimensional question. Now, you can, because it's complex, there are more opportunities as well. And if you have the ability to manage the math and the science, there are great things to do. But I guess my point here is, if you're looking at a cleanly packaged ETF with a very clear, simple, rules-based strategy, good luck. We're dealing with items that are non-linear and multidimensional. There are trends that you can take advantage of that will do broadly better than others, but that does not mean they will consistently in all scenarios perform as such.
Okay, I think that's perfect. All right, one more question, and then we dive into your incredibly exciting topics. And it's a question from Rick. Rick has been very patient because I think he sent in the question quite a long time ago. And he wrote, "Hi Niels, looking forward to the next TTU with Cem. If possible, would you ask him if he views the Jan 24 OpEx as a possible inflection point to the downside? Thanks so much."
Yeah, I've actually been pretty vocal about this. I've even circled a date on people's calendar. To my own detriment, I do this sometimes because there's reflexivity in the market. January 17th, I've circled as a very important date if, and this is the key, conditionally, we do get a bounce back here into the end of the year. To be clear, I also circled November 1st as a date for the beginning of that rally inflection, which was pretty spot on. I also highlighted that it could very likely be a violent move off of an area somewhere between 4,100 and 4,150. So these numbers matter, and there's a reason that we point these out. I would pay attention to it. Markets are reflexive, and not just from and we'll get into this with the topics, but not just from a structural perspective, right? This is what Vana and Charm, this is the dealers taking on positions and then forcing a reflexive outcome that we've talked about. These structural flows get stronger going into the end of the year here, but also markets are reflexive from a macro perspective. Policymakers respond to markets. And that's what we're seeing incrementally here from the Fed, from the Treasury into the end of the year. So the more risks there are, the more the Fed tries to dampen volatility, the more the Treasury tries to manage it. And that's particularly true going into the end of the year as well, because there's other factors in the end of the year that can accelerate and cause problems. It's an important inflection point, center of kind of gravity, if you will. And so that reflexivity of market factors, and we'll get into this a little bit later in the show, and what the fundamentals are, flows are doing, paired with all the seasonal strong structural flows that are just systematic relative to conditional probabilities that happen in the market, are likely, as I mentioned, to drive positive flows here into not only the end of the year, but into January 17th specifically, because a lot of those flows are January 1st. And then you have a very strong seasonal buyback to Vaughn and Charm flows into that January OpEx. and which should continue to support it and maintain that momentum until really kind of that window. And this is why February, last back half of January, and then February is actually the second worst month seasonally. And it's really a function of the positive flows that come before it more than it is the negative things that are coming. But removal of positive flows in the context of negative flows is very negative, right? And so that January 17th date, which is the Wednesday of expiration of OpEx, before that Gen OpEx, I would highlight as a very important time if we do get the seasonal positive flows here that I think we are going to, that we are beginning to get. You can see it. We've had a more than a 5% rally in 3 days. That is a very important date and period to highlight if we can get that positive move.
Yeah, no, great. Well done. Good call on that, Jim. Another one. All right. Well, let's dive in. I think the first part you kind of labeled macro, which is something you and I love to talk about. You also kind of labeled it, what's new. And so I'll kind of let you lead with that, and then we kind of see where we go with that. I have a couple of things I wanted to ask you, but why don't you talk about what you think might have changed or what's new in the macro space?
And this will dovetail right into what we were just talking about, right? So policymakers are reflexive, and we got a 12%, didn't feel that violent, right? But we got a 12% pullback off the highs over the course of the last kind of month and a half until recently. And, importantly, bonds started to experience some serious volatility. And that was primary driving factor, I would say. Actually, I would say it's a secondary factor in the sense that it's not really the bond yields that's the problem. That's how people talk about it on CNBC and whatever. It's actually the thing causing the bond yields to go higher, which is the amount of issuance that's happening, and the liquidity draw that's pulling out of the markets that's affecting supply and demand, not just in the bond market, but in the stock market as well. And again, that's an important distinction because I think people will just think, oh, numbers, like the yield's going higher, so that's bad for liquidity. No, actually, what's bad for liquidity is that the Treasury is issuing so much paper and there's not enough liquidity to support it, and that money has to come out of the market broadly. And how does that come out? Well, if yields do go up and somebody has to take the other side of that. If they're willing to take 10-year at 5%, they need to make room for that on their balance sheet, and maybe they need to sell some equities or lighten up, or maybe instead of buying equities, they're buying bonds. So all of this creates a liquidity draw, and it's been significant. We talked about this, by the way, months ago that this was coming. It's just you had to kind of see it happen, and sure enough, eventually, as always happens, it keeps going, and then it starts to move faster, right? And at the end, those yields really started to move. In a 7-day period, the 10-year went from 4.5 to 5.05, right? That is an incredible move in speed. And in the last 3 days or 4 days, we've seen it go from that 5.05 back down to 4.65. So this is incredibly kind of volatile price action. What's supposed to be the most liquid market in the world, right? So reason for a little bit of concern, I think, for policymakers, especially when it was starting to kind of break out fast. Those yields were starting to break out fast to the upside. You'd hate to see a air pocket 5.05 to 5.5. And that, given the speed of moves, that's a real concern. So those are the major kind of again, it's not that the 12% drawdown in the market's a huge deal. It's not that a kind of 60 basis point move in yields over the course of a month is a huge deal. It's the volatility, it's the liquidity picture and the concerns that come with that, particularly as you get into the end of the year. Why is the end of the year? Why is this seasonality part important? Regulatorily, banks and entities have to have a certain amount of capital on their books on December 31st. And so if the liquidity picture gets bad the next month, you have a real pocket of liquidity where people, A, don't want to come in and provide liquidity, but B, that there's a draw on liquidity broadly coming back into balance sheets, and that can create an even bigger liquidity issue, right? So the Fed and Treasury should be on alert more than usual during that period. And then, and it doesn't help then now to the part that's probably geopolitically, this is a much slower moving thing. This is not a 1-2 month thing, but a very important development, a new front on World War III, I'd call it. I know that sounds bombastic, but that's what it is. And I don't think people are talking enough about that. The Hamas-Israel piece is not independent kind of activity that's happening in a part of the world. Obviously, it goes without saying Iran is backing Hamas in this endeavor, and Iran is very vocally a part of a group, which is Russia and China, trying to exert leverage. And they're doing it because there's another front going on, Russia-Ukraine. And then, in my opinion, there is a potential front coming, further east. And I think people know what I'm talking about there. So this is a stretching of resources, a challenging and testing of boundaries by a much bigger set of entities. And this is a proxy war, much like Russia-Ukraine is a proxy war. And explicitly, the last thing I'll say about this geopolitical piece is it is a very strategic move, too. It is not just opening a new front. If you have a coming world war broadly, you are trying to take entities that are on one side and really convince them to be on another. And nowhere is that are there entities more walking that line that are easier to win over to the Russia, China, Iran front than in the Middle East. And nothing is more of a lightning rod than the Palestinian-Israeli conflict, particularly somewhere that's true to my heart, which is Turkey, and another one, which is very important for commodity reasons, which is Saudi Arabia. These are two very important allies in that part of the world to the West, and they are entities that are now very much against what's happening in Gaza. And if you were to listen to if you saw the crowds in Istanbul, right, protesting what Israel is doing. This is not by the way, I have very different views on a lot of these things. So I want to make sure this is not an argument of what should or should not be happening. This is simply power and struggle. And I want to be clear, this is an effective means to separate or at least bring question into the alignment of Turkey and Saudi Arabia with the West. And that is a major problem. Honestly, I believe Israel's politically taking the bait here in something that they should not be doing. And I think the U.S. is aware of that and trying to talk them down a bit, but we will see. We will see. Anyway, so the geopolitical piece is important. I know it's interesting. We could talk a lot about geopolitics. We don't want to get too far down that rabbit hole. And that does not matter as much for the 1 month, 2 month predictions of what will happen to markets in the very short term, but it does matter if we're starting to think, okay, things are heating up a bit. These are strategic moves. Why are these strategic moves being made now? What does that mean for timelines on other fronts and other bigger conflicts? What does that mean for an acceleration of what we've said is coming, which is this broad geopolitical conflict? But those things move much slower, and the markets react to those things on much slower timeframes.
On a personal note, I very much agree with you in terms of the importance of these events and the fear of where this could go. And it's actually not just the countries that you talk about that is starting to where you start to see cracks, even within Europe. You start to see cracks in terms of alliances. And so this is something that you and I will end up talking more about on the Global Macro Series. I'm sure we need to find a few people to come in and help us digest and navigate some of these things. But I wanted to pick up on some of the things you said before we got to the geopolitics. A couple of things. You talked a lot about the situation in bonds. Now we talk a lot about the VIX. We don't hear much about the MOVE index, which is the equivalent for the bond markets. I don't follow the MOVE index, but is it behaving the way it should, so to speak? Because we know that there has been a bit of a decoupling between what the VIX has done and what the S&P has done. But is the MOVE index actually behaving as it should? A lot of people trading it. I don't even know how you would trade it. So can you talk a little bit about that?
Yeah. So bond volatility has, as we mentioned, has been relatively insane on a realized basis, and on an implied basis, it's also quite strong. Yes, things are moving much more in line realized versus implied than maybe on the equity side. We highlighted this about a year ago, you and I talked about it at some point, I know, about how during inflationary regimes, different volatility performs very differently. If you're in a period of non-inflation, vol tends to be correlated because things are much more about cyclical realities. But in secularly inflationary periods, you get real breakdowns and real changes. We're entering a period, without going back into the whole thesis, right, of broader geopolitical strife, competition as opposed to cooperation. That leads to more some pressures in commodities, some breakdowns in certain types of businesses. It causes more rotation. So all of these things lead to higher volatility historically, and there's lots of power by the Federal Reserve broadly because the Fed's in a box. It has a dual mandate that it's struggling with now. And questions of dollar strength, dollar weakness come into in these geopolitical. So during these times, FX, rates, precious metals, all of these things tend to get incredibly more volatile. And not just more volatile, but the vol increases on them as well. Whereas certain assets, ironically, get more vol dampened than you would expect. So we said this about oil a while back. When oil vol exploded on an implied basis, and gold was very cheap. I don't know if you remember that. And we were very vocal that gold vol was too cheap for that reason. But oil vol was actually too expensive. And sure enough, oil vol has actually kind of settled in a bit, and we continue to see this put. That it's not a very, we're not getting convex moves to the upside. We're getting more kind of choppy sideways action because OPEC and other entities that have power are able to underpin price and exert power so that it kind of continues the trend higher. But broadly, it is not a volatile move higher. But whereas gold is starting to act really kind of more volatile, and vol is increasing from those lows. So we highlighted this over a year ago, and this is what happens. And so to your point, rates vol is, yes, it's disjointed from equity vol. And by the way, equity vol does very broadly, very poorly on a medium to long-term basis. We highlighted 68 to 82. Market went nowhere for 14 years. That's not very volatile on a long-term basis. Yes, there were some incremental short-term vol in between, and there's more disjointed kind of moves. So term structure should broadly change. But equity vol, it makes broad sense that it would not be dramatically higher, if anything, a bit lower, but disjointed from rates vol and FX vol and other vol that people have not thought as much about in terms of hedges, and probably should be.
Absolutely. I want to, again, before we leave kind of fully the global macro, but obviously also tied into the fixed income side, I wanted also to hear your opinion about something that I heard from our friend Grant Williams on his one of his latest episodes with James Aitken and Bill Fleckenstein, and I think this is first there's two things that really stood out for me in that conversation, and you and I should get Grant back and talk about this. One is that I think James Aitken, who has sounds like incredibly smart every time I listen to him, was where he was saying, a lot of the stuff that I've sort of thought or believed in for the last couple of years, I really need to unlearn that. Things are just not playing out the way they should, and there are probably some reasons, and I'm not going to go into that side. But the other thing they talked about, which I actually think is quite interesting, and that is this risk of Japan actually going into their own rate hiking cycle, and what that might do, and not least in terms of who's going to be the buyers of all these treasuries that we're going to be issuing and so on and so forth. So is this something that you've kind of thought about as well in terms of what could the next leg be? And even though I think we both, at some point, the US bonds are going to get a break and they're not going to continue down forever, right? At some point, at least for a while. But then there's this joker of Japan. If they kind of start doing their thing, that might put pressure on at least yields staying high for a lot longer, not just for longer, but for a lot longer than people might expect.
I want to bring up a very, I think, important mental model on this. We've talked a lot about the deglobalization and the geopolitical issues that come with protectionism, which is a a cousin of populism, right? We're getting more protectionism and more geopolitical strife and competition. That, importantly, though, extends to liquidity. And when you're talking about big liquidity, like, borrowing issuance of trillions of dollars of debt, when we're in a cooperative world and China and Japan can fund debts themselves and we're more stable and cooperative, liquidity is great. But when that starts to break down, you can be fine for a while. But the tail on liquidity there, who's going to provide that liquidity when there's very few that are willing to, really becomes a bigger concern. And I think that's what you're essentially highlighting, right? It's not just Japan. Japan is kind of a vassal. I don't know, that's how any Japanese people on here will hate that, but it's a smaller economy relative to, let's say, the U.S. and its ability to keep its rates down as it was is a function of the power of the West and its support of Japan to a great extent. So these are not separate entities, is my point. And the liquidity question is broadly a problem across the board. And but it would make sense that in particular Japan, which has gone kind of the furthest negative, right, will have the most room to kind of normalize in a scenario where things get ugly. I actually, at the CBOE's RMC conference where I was at several weeks ago, met up with our friend David Dredge. And he and I had a lot of great conversations, and the topic of Japan came up multiple times. He is very involved in Japan and is of the opinion that we're pushing on a string. This is going to be not pretty, hard to say when, but at some point, it just has to normalize. And I agree, the pressures and the incentives are there such that unless we unwind this kind of realities that we're seeing in terms of geopolitical strife and broad competition globally, that is going to normalize at some point. And I do think that many people are seeing that. The question is, when people are seeing it, is that, how will it transpire? Will it be in steps? How long will it take to transpire? Those are questions that are harder to answer, but agree with you.
Yeah. Maybe as a final point before we leave bonds for a while, at least, one thing that I think people may not be so familiar with. Of course, for the longest time, we've always thought about bonds being the safest assets and so on and so forth. You highlighted that actually volatility in fixed income markets are now higher than in the stocks. The Bloomberg also had an article out on the 22nd of October talking about that. But there's one statistics or little analysis that I did, which I thought was quite interesting as well. And that is just if you take the max drawdown of different asset classes and you divide it by the annualized volatility, because again, I mean, you want the lowest ratio as possible, so the smallest drawdown. But what you find is that bonds just blow out everything else. Stocks, trend followers, CTAs, whatever, so much more downside volatility, so to speak, compared to its annualized volatility. And this is always the danger, that things that may look safe turns out not to be so. And I think what we will find, and I actually believe you and I completely agree on this, because we've been talking about this for a while, and that is we are probably heading towards a world where lots of investors are completely wrongly positioned. They're simply positioned for the world that was, not realizing the world we're heading into. And that will have major consequences in many financial markets. So I don't think our conversations are...
Yeah, I would highlight two things to that real quick. One, people come to me all the time and say, how am I supposed to make money in this world? Like, this seems impossible. But the problem is not that there's there's more opportunity than ever to make money, right? There is we're in a regime change. If you want to make money, this is what you want. You want new opportunities and things that are mispriced. And there's tons of that everywhere. But you have to get out of this kind of prescriptive, this is 60-40 is the way things work and how you make money. And it's so hard because it was so simple. And everybody did the same thing without any education for so long and was taught, indoctrinated that this is how you invest. It's low cost, zero fees, buy and hold, buy the dip. And it doesn't really, it's based on a lot of assumptions that held true for some time for structural reasons that we understand. So I just think that, everybody's got to kind of be willing to look outside the box a little bit and say, okay, there are other opportunities that are significant. We just need to kind of stop trying to do the same thing over and over again. That's one. And then, two, I think that, the reality is geopolitical realities are such that we are going to get dramatically more, not only is the system going to be different, but there's going to be real tails. You can't, the Fed, Japanese Central Bank, JGB, like everybody has compressed volatility. What do we say? You can't get rid of volatility. You can only transform it. And so what's happened is we've transformed it in the bond market to very low vol, but with a really fat tail. And that's what you're essentially asking about with Japan's central bank is they, incorrectly, overly suppress vol to a point where things have gotten to a price and area that when it does break, the normalization is going to be dramatic. And I think that's true globally for bonds. And I think the volatility itself is starting to expand to adjust for that. And hopefully the volatility expands more before the tail comes. So at least those ratios are a little bit more in line than what we've seen historically.
Yeah, no, absolutely. You have a section in your topics where you talk about markets are reflexive, and we've talked about that kind of already, but I want to maybe spin it in a slightly different way and maybe a little bit towards the, just a comment, maybe a thought. I'd love to hear your reaction to it in terms of another topic that we speak a lot about, which is inflation, which kind of underpins the whole idea of where interest rates may go. And I think maybe what I'm sure many people have thought about by now, but maybe not a lot of the people sort of who go about their own day-to-day in terms of investing. And that is when you have all these global conflicts that we now have, and as you point out, there could be more, it puts an enormous amount of pressure on spending on military. Lots of this is just pure deficit spending, especially in the US, right? But probably in a lot of countries. And I wonder whether that's additional spending is simply going to be what, to a large extent, will underpin inflation and keep it high and simply not allow central banks to do what they had hoped for, which because they didn't know what was going to happen in, say, the Middle East. They don't know what's going to happen next if another conflict breaks out. So all of their projections, which, by the way, rarely holds up anyways, but all of those projections could be thrown out the window potentially if we just continue to see this demand for military spending.
We highlighted this 2 years ago. I keep saying those things, but we did. We said, look, everybody was talking about fiscal 2.5 years ago. Oh, fiscal's driving this inflation. And the comment was, look back at the 70s. Yes, fiscal was part of it. But the bigger story is not just fiscal. It is the populism that's driving the fiscal. It's the populism that's driving protectionism and deglobalization, which is then causing more global conflict and more investment and war. It's the populism that's driving that protectionism, and that's driving entities like OPEC to put more pressure on commodities. If you look at the 70s, you'll online, you Google what caused inflation, you'll hear three independent things. People will say fiscal spending from the Great Society program, the Vietnam War and geopolitical wars, and three, the OPEC crisis. They're all the same thing. They're all the same thing. And to my point, to what you're saying, the war, the funding of wars is going to be a major driver to more fiscal. Right? It's their cost to it. These things are stimulative, but they're also very inflationary. And there has to be more issuance to cover it, which is going to mean yields go higher, which is a liquidity draw on markets. These are all related. They're all the same thing. And I think that's the thing that policymakers and, very rarely spoken about really and understood. But 100%, there's a reason that the echoes are so similar to the past. And I'll make one last important note there, Niels, is the funding of wars is actually not only likely given the geopolitical issues, but it actually will allow for the continuation because people will pay for wars. fiscal may not be popular at some point. People may say, whoa, stop spending. You're spending too much on discretionary things. War is not considered discretionary. War is essential. Defense is essential, I guess I should say. And so that is what happened in the 70s, even though there was a broad understanding pretty early politically. There was lots of fights over the Great Society program. You can look back at it. Fiscal continued through all kinds of election cycles because of the Vietnam War and broadly the support of that war. And you can look back to, World War II as a similar analogy as well.
All right, we have two major topics we want to discuss before we wrap up. Both very interesting. The first one is flow, something that you always bring up. You are the maestro of explaining this so that we all understand it. We've kind of touched upon it a little bit already, but let's just make sure that we get sort of your full take on the flow side of things as we head into year end.
Yeah, these are things I've talked about before.
Yeah.
So I'll try and be quicker about it, but I do.
Yeah, because I know you mentioned a little bit about Thanksgiving. I know you mentioned a little bit about some holidays coming up. Yeah,
there's a couple nuances which I think I haven't highlighted enough, which I would like to highlight. But first and foremost, seasonality is not a magical construct, right? We've talked about this, particularly this no-dece early January period, this, call it 2.5 month period, which is a pretty long, big part of the year. There's a reason it's structurally more positive, and particularly certain windows of it that are structurally more positive. One, volume-weighted time drops dramatically. And what do I mean by volume-weighted time? There's just less trading going on during this time. There's more holidays. There's more people not participating in markets. There are, Thursday's an official holiday for Thanksgiving in the U.S., but the Friday it's essentially a holiday. Nobody's here, right? Things like that. Christmas, it's one day as far as the holiday, but guess what? That whole week is dead. And so if you look at volume weighted time to try and adjust, for this, dramatically less. And I think that's an important distinction. Not just that, but this is an important thing I haven't really highlighted. I talk about kind of different windows where there's more risk, right? And we see this. There's a reason, if you can't see it now, like you're not paying attention, right? After expiration, big expirations, you get significant different moves in markets, and there's more risk during certain periods. People are waking up to this. These windows the windows of weakness tend to be after big structured product expirations, and it's important that these biggest holidays or the vacuum of time and trading happens after these OpExes. And we haven't really highlighted that, but Thanksgiving is directly after November OpEx, right? It's this week where there should be generally a risky week, but there's nobody trading. People are on vacation. So we accelerate through kind of this risky period. Christmas, same thing. It's right after December OpEx, right? And then, and a week later we have January, the New Year's Day. And so those big holidays are actually, interestingly, even more vol compressing, even more positive for markets because of where they're situated. I know that sounds like, why would that matter? That sounds insane. If the holiday was 2 weeks earlier, would it really matter? Yeah, it would, because the way it lines up with structured flows is important, and that dynamic is very important. Importantly too, massive open interest in December OpEx and January OpEx. Why? In the indexes, broadly, people hedge at the end of the year. These are the options that are listed as leaps years in advance that have tons of open interest and that are big structured hedges. Structured products are therefore tied to these expirations as well. December monthly expiration is the biggest. You have a December end of the year expiration, which tends to be big. And then in single list, historically, January has been the biggest expiration. And we can get into kind of all the reasons why that developed that way or why it is, but it's still a major expiration right at that January 24. So all of this open interest and, importantly, skew, all the puts in the market there are priced high. Dealers are short them. And so as those disappear, if we do not get a volatile event, which we have kind of managed it here going through October, all of a sudden that starts to come out of the market and the hedges have to be bought back. So time gets compressed. Where time gets compressed is softer. The amount of buyback is much bigger because these are important end-of-year expirations. This is all from the OpEx and flow side. And then on top of that, we have all the structured product issuance that's new. that's been there, around this last year or two, that's really compressing and holding things together. So it's limiting the odds of a bigger move that's going to disrupt these natural structural effects. And then lastly, end of the year flows, the market's now up. The market continues. There's a momentum factor here, continues to be relatively strong, and hang in there. Time is not a bear's friend, I've said. Why? Because there's a natural momentum factor higher. And the more momentum there is at the end of the year, there's more collateral to reinvest at the end of the year. And that is a big amount of flows. Again, we're talking trillions of dollars of flows that hit January 1st, new entities putting money to work. And people see that coming. So end of the year, Santa Claus tends to be strong when that's the case, and the January effect tends to be strong. Those things are not a coincidence. So that's the flows picture. Very, very positive for risk here if things continue to hang in, which they obviously, people are picking up on what I've been saying and buying the indexes the last several days.
Okay, well, the last topic will be interesting and fun, I hope. Because it is kind of your takeaways from the recent CBOE RMC Conference, which of course took place in a very exotic place where there was a Formula One race going on recently in the US. So I don't know how much of the details you're able to share, but I would love to hear as much as possible from what you took away and maybe some of the people you spoke to and the topics discussed, because clearly there were a big group of smart people at the same time.
Yeah, this is like the premier conference for derivatives and vol, specifically globally, I would say. The CBOE, it's smaller in the sense that it's not maybe as big a reach as some other vol conferences, but it really is a who's who in terms of proprietary trading firms, entities that are really in the weeds and trade derivatives, provide liquidity for derivatives. So it really is the gold standard for kind of thinking about what's next and seeing who's doing what in the space. I was fortunate to be asked to be on a panel of about 15 people to discuss new products of the CBOE for idea generation, as well as working on details of how products should work and problems that they're maybe facing. That was really incredible. Again, a who's who in that room of people who are practitioners and entities leading the charge on a lot of these products. That was fascinating. A lot of discussion about the dispersion index that the CBOE has released in dispersion broadly. Other products they're looking at and thinking about. The dispersion index, it will have futures coming. They announced that in that small room, and then more publicly later in the conference. So futures, options on futures, all of those will be coming for the dispersion index. I think that is a particularly important, development in markets, not because it allows people who are practitioners to do dispersion as much, but because it provides now access for more structured products and ETFs and other entities that can now more systematically deploy these strategies and provide broad market liquidity into these strategies, as opposed to just niche players who have access and whatnot. And given the size of the dispersion trade and the imbalance of the liquidity that you and I have talked about, both from structured products and the bidding of indexes, right, but also from the broad increase of volatility in the single list for more idiosyncratic risk, this is what's driven this historic dispersion that we've been seeing, an imbalance of supply and demand, different, from the index center to and constituents on the other end, providing liquidity there and allowing access for broad assets will be a very important and interesting dynamic as it transpires to market structure. And I think that's a critical takeaway. I will say there's still a lot of evolution. This is not going to happen overnight. One of my big takeaways was that the index is not Vega neutral. It's a long Vega index. They did that on purpose, so it would be more mean reverting, and the number would make more kind of sense to the average person. And it's meant to be an index and more of an indicator at first, and then they'll put products on it. But as a deploying of the dispersion strategy, it's not actually the proper structure to deploy the dispersion strategy per se, because it's not Vega neutral. My guess is, and some of the input that I gave and other people gave, that they really need to launch a Vega neutral version at some point. We understand that will drift and that there'll be other issues for those products. But I think that's what the world really needs and wants. If not, there'll be innovation outside of the exchanges to kind of, I'm sure, deploy a more vague and neutral version of the dispersion index. But anyway, so that was very interesting. The staying power of dispersion and why, what I've been talking about now for years about why it's happening has become a little bit more talked about for the first time at these conferences. And I think that is becoming a more central to the zeitgeist. People are waking up to the fact that dispersion is working for certain reasons based on structural supply and demand imbalances. This is not something even at those conferences that was broadly understood or talked about, which I thought was very interesting. It's entering the zeitgeist. I think those were all very interesting topics as it relates to dispersion. There were a lot of other issues. Our guy, David Dredge, again, got up and he spoke at the conference. I thought that was one of the better, as per usual, one of the better speeches that were given. He gave real historical, big picture context to several things. One, really talked about how vol broadly has been compressed relative to, this kind of touches on what we were talking about earlier, relative to, 800, he was looking at 800 years of history, looking at, which I always love. He goes really deep when he looks at these things, and he was looking at British records that they still have going back 800 years. And volatility of assets was dramatically higher across all scenarios, except for maybe one period, 20-year period in the late 1800s, which was maybe related. The last 20 years up until 2 years ago was across assets, the lowest volatility that we've seen. And that was a really, really interesting kind of historical point. We're starting to see some mean reversion to higher levels. And his prediction is that that should continue to be the case, particularly if interest rates stay higher, because you look at when inflation is higher. When you look at those periods, vol tends to be also considerably higher. And again, we're not just talking about equity vol, we're really talking about rates vol. We're talking about, the move index that we highlighted, other things broadly, but that's where the volatility tends to be higher. So that was an interesting look. He also really highlighted something that he talks a lot about, and I've heard, which is an incredible point, that the majority of the returns in markets can be defined by simply what happens to the top 10% of outcomes and what happens to the bottom 10% of outcomes in equity markets and markets writ large. If you take those two out of the equation, or emphasize one, you take one out and you add the other one in, the performance goes to dramatically negative or 10x positive performance, and he brings that up to highlight the importance of the tails and hedging the tails, and not only hedging them, like making sure the worst case scenarios are well hedged, but also making sure that when a positive occurrence happens, that you capture it, or maybe even capture an even bigger amount during those moves. Those tails are incredibly undervalued to the importance of a portfolio, and this being a risk management conference, important thing to highlight. He highlighted several ways to take advantage of that, but I think the big takeaway, and again, it's hard to express how dramatic the differences are if you take that 10% of occurrences out or in to the portfolio, but it's pretty impressive when you look at it. I'm happy that he has, I know on David Dredge's website, he has the actual presentation on there. So I recommend that people maybe go take a look at that if they're interested. Lastly, two more things actually I'll say. One other important topic that was covered was this idea of the era of nominal illusion that, again, we've talked about on here, but everybody talks about assets in terms of nominal. And overwhelming majority of assets are priced nominally because nominal and real haven't been that different for 40 years. There's a need for innovation to make sure that assets are more looked at in real terms. Everybody thinks it's great that they're getting 5% in the 10-year and like, oh, no brainer. But in real terms, how are you really doing? And that's the thing that very few people think about, and it's so critically important. Again, we've talked about the 70s, but there's a dramatic need to focus on assets as real assets, and there's very little infrastructure that allows people to do that. And the big question is people, big money looking around at entities that can do that for them, and there aren't many that do that well. We even talked about in that kind of private little product innovation, conversation about, look, if you're looking to hedge break-evens, but not do it just, trading break-evens, how do you do that with convexity or non-linearly? There's literally no way to do that. It's inflation. We're talking about one of the most important dynamics in the world, and there's no way to broadly hedge it. It seems like a problem, right? So these were, this idea of it, we're in an era of nominal illusion. I thought that was a nice kind of semantic way to express it. I think was an important takeaway. And then lastly, we would be remiss if we didn't mention zero DTE, and of course, that's not going to go undiscussed at the CBOE's RMC, given that that's something like 40% of their volume. They put out studies and have funded. This is like drug companies, right? They always fund the idea that expresses how their drugs are great. The CBOE funded a study. I love the CBOE obviously, but I thought it was an interesting study. But they were very adamant about how the balance of trading in zero DTE is incredibly balanced, right? The supply and demand between these things. It hasn't been in balance between dealers and customers, and it kind of represents how robust and stable those markets are and have been. And so that was something that was highlighted and discussed. I actually raised my hand. Another gentleman raised their hand at this panel, and I think led to some very thought-provoking conversation there at the conference. And I'll share with you what a couple of the questions were. The other good gentleman was at my table, Noel Smith from Convex, and we're friends, and broadly we're talking a lot. But the point I highlighted was actually the margining issues with zero DTE and how there is no real-time margining for any of these, and they all expire without any margining. So you're essentially dealing with a market. It's the Wild West that has zero margining. There's zero regulatory margining for these things. That's insane, right? And I think the fact that it's gotten to the scale and that hasn't been dealt with is a major issue. I brought that up, and there was a lot of back and forth about whether it's coming and what I kind of learned is that the regulators are really looking into this and focusing on it, and that things are coming there. So I think that's something to highlight here, before anybody else, that I would not be surprised if there starts to be new, different margining regulatory things that change the landscape of zero DTE a bit. So that's a big thing that was brought up. And then two, Noel asked a great question, very simple, but very important. So if everything's so great, what could go wrong? And that's always a great question to ask. And there was a lot of hemming and hawing. It got quiet for a second, right? Like nobody wanted to be put, have their, hand placed to the fire. But then I was actually very impressed. The gentleman from Capstone who was there, who's like kind of their head of global vol, really kind of stood up and said, look, there are major risks to zero DTE. And the risk primarily is that we're providing liquidity, and there's a lot of lot trading and a lot of liquidity happening, and a lot of changing hands. But if somebody, you can't, they said, we do not hedge these. I thought this was interesting. You cannot hedge them, and I agree with this, with deltas, with, other options. You go out and you kind of sell your futures, or you can push liquidity to the rest of the market. These are so far on the tail, you can only trade zero DTE with zero DTE. You can only hedge one with the other. And so that's great as long as the liquidity is there. But all of a sudden, if somebody comes and sweeps zero DTE and there's nothing to hedge it with, right? And now dealers are very imbalanced, you could have a major flow problem, and it can happen instantaneously. So things may appear very balanced, but things can change very quickly, and they really is no way to push that liquidity to the rest of the market. And so there's this zero DTE thing that's not only can be very violent and dramatic, but it's a small sphere that can only hedge against itself. And so I think that was a really important takeaway. And then the last thing that was mentioned is the other major risk is there's a lot of now innovation happening in the area, and a lot of ETFs and other entities, other liquidity coming into the market that can be one-sided. And so up until now, it has not been very one-sided, but if there's an ETF, which there is being launched right now, that is short vol, zero DTE, or something along those lines, that can then lead to very one-sided flows that can make that market more structurally imbalanced than it has been. And there are fears that may actually happen, much like it happened in, let's say, GME and AMC and all these other things. If you get one-sided other entities that are not two-sided, then you can start to get some real imbalance that could cause more structural issues. So that was the other thing that was. It's a very interesting conference. There's more I could talk about, But I think we only have a limited amount of time, and maybe we do another pod at some point or talk about these things in some other form.
Absolutely. It does sound like I missed out on a great conference, and we may have to go back to this, because I did note from your notes that in one of your points you even mentioned the words trend following, which piqued my interest, of course. So
yeah, there was some talk about trend following as a solution to dampening some of the volatility of portfolios. There was David Dredge mentioned, another gentleman on there had a graphic that was essentially showing trend following's historic performance outside of the last 10, 15 years for hundreds of years of history, and how dramatically superior it has been historically than the last 15 years up until the last 2 years. Obviously, it's been a good 2 years as well. And it really expressing how this period could very well be a mean reversion, much like volatility, has done better and historically, as we break into a less compressed, less kind of two-dimensional world into something where things can start to trend and then trend for a while. Or, if we're in this type of regime shift, it might be a very great time for trend following broadly, and that it'd be dangerous to look at the last 2 years and say, well, this is outside of the last 15 years of history. The point was that you might really be missing the big picture, which is there may be a normalization on these strategies relative to broader history.
I mean, I completely agree. And we're not going to talk about that in much detail right here and now because of time constraints. But what I will say, I just got back from our own headquarters, and Don has been, we just celebrated our 49th year in business. So very few firms and very few strategies has an actual 49-year track record. And it gives us the quote-unquote advantage that we've actually traded through some of the regimes we're seeing now coming back. And what I will say, when you look at different periods, whether it's high inflation or even from, 82 to almost 99, I think, where we had low inflation, but not necessarily stable inflation, which could be where we're heading, where it doesn't have to necessarily go completely crazy, but it's not going to be as stable as it was from 2000 until 2019-ish. And yes, you're absolutely right. We see that in our track record as well, that there were some amazing opportunities. So I share the optimism expressed at the conference, and I'm sure you and I will debate this with some of our friends.
I feel like we're like the CBOE. We're talking our book here.
Oh, yeah.
No, but obviously I agree. And that was the broad takeaway from the conference. So I thought that was really interesting.
Yeah, no, absolutely. Good stuff. This was wonderful, Jim. Great to catch up with you. I'm sure the audience will appreciate all the insights that you once again have shared today. And as I said, I think you and I need to just identify some of our friends to come back and talk about some of the topics, since some of them, it's been a little while since we caught up with them. Anyways, if you enjoy these conversations, please go to iTunes, Spotify, Amazon Podcasts, wherever you listen to your podcast, leave a rating and review. It really does help, and we so much appreciate it. If you have questions for the next co-host on the podcast, which is next week when I'm with Katie Kaminsky, the queen of Crisis Alpha, if I can put it like this, she will be delighted to tackle your questions. And as usual, you should send them to info@toptradersunplugged.com. From Cem and me, thanks ever so much for listening. We look forward to being back with you next week. And until next time, as usual, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.